There we go. All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Thursday, everybody. Today's July 18th, 2024. And the top story this morning is semiconductors again. Yesterday, we had an absolute bloodbath in semiconductors. Everything was down. Not really sure why. Was it a secular rotation out of the incredibly overcrowded trade in chip stocks? Maybe. Was it the former president's comments about Taiwan paying for its own defense? Maybe. Or maybe it was this tariffs thing, or maybe it was this worry about export controls being filed against some Dutch and some Japanese companies. There was all kinds of worry in the chip sector yesterday. Stocks sold off hard. The NASDAQ dropped almost 500 points. But then this morning, Taiwan Semiconductor rides to the rescue. We got earnings from Taiwan Semi. That's the biggest chip manufacturer in the world by a huge margin. And they reported pretty fantastic numbers because, well, companies continue to pour hundreds of billions of dollars into AI hardware. Big tech is building out data centers like gangbusters. And so you're going to see a pretty consistent theme emerge today as we go through some of these company earnings reports and the stories that are coming out from various companies. You've got big tech has hundreds of billions of dollars to spend on this speculative investment in artificial intelligence, and everybody else is broke. I'm pretty sure I just summarized the entire state of the global economy. All right, so Taiwan Semi, big beats, all right. Net profit 36% to the upside. Revenue up 40%. All right, raising their guidance. There is no slowing of the investments in the AI hardware yet. Emphasis yet, because remember, guys, the chip stocks are making the money. NVIDIA is making the money. Taiwan Semi is making the money. But all the people who are ultimately using these chips do not make any money. Some of them don't even have a product yet. And that's, what do we have? $16 trillion has been added to the S&P 500 since ChatGPT was first announced. Almost $7 trillion of it just in big tech alone. So, I mean, that's a pretty big speculative bet here, but it's not slowing down yet. The companies are still pouring money into GPUs. So, you know, if you're looking for the pin that's going to burst that bubble, it ain't today. That's for sure. Now, we got a lot of other stories going on that are showing consumers, notably low-income consumers, are having a hard time. Domino's Pizza stock is under pressure this morning. They actually reported halfway decent numbers. Same-store sales up 4.8%. Revenue was up. EPS was up big, but earnings per share was up mainly due to a revaluation of this DPC Dash. That's one of Domino's big Chinese franchisees. But it looks like the numbers overseas aren't looking so good. The same store or the same restaurant sales for Domino's non-U.S. stores was very low. And there's reportedly some trouble with a franchisee outside the United States. They're not saying which one it is, but they canceled some plans for almost 200 of their new stores that they were supposed to open this year. They're canceling plans for that. So whatever's going on with those overseas franchisees, that's having a little bit of a drag on Domino's stock this morning, although Domino's stock is up so much year to date that you could argue that it was due for a pullback. D.R. Horton, meanwhile, is also under pressure. Pretty bad numbers from D.R. Horton. Their net income was only up 1%, not even keeping pace with inflation. Revenue up 2.5%, again, not even keeping up with inflation. New orders was very disappointing. Rental income was way down. So D.R. Horton is under some pressure this morning. You know, that's one of the biggest home builders in the country. So real estate market starting to show some weakness, some cracks there. Five Below got absolutely crushed yesterday. I mean, just absolutely destroyed. First of all, their CEO, he's out of there. He's quitting. They lowered their earnings guidance. Five Below has a lot of headwinds that they got to deal with. First of all, the low-income consumer, they're focused, they're spending on just outright necessities. The people at the very, very bottom of the income spectrum, they've just been absolutely bludgeoned by inflation, and they don't have money to spend on cheap imported Chinese crap at Five Below, right? If you're wondering, how am I going to eat? How am I going to keep the rent paid? Then you're sure as heck not shopping at Five Below anymore. So that's a big problem for them. They made a big investment in Squishmallows. Apparently Squishmallows, I mean, look, my kids have Squishmallows. They love them. They're cute. Okay, I get it. But Five Below just went out and bought way too many of them. It turned out to be a fad. People aren't buying them anymore. And now they've got this massive pile of stranded inventory that nobody wants to buy. And then, of course, there's the looming threat of tariffs. As Trump surges ahead in the polls and it becomes more likely we see a second Trump presidency, we're probably going to see increased trade tensions between the U.S. and China. And look, even if Trump doesn't win, even if by some miracle Biden manages to pull this one off, I mean, hey, it could happen. It's the 2020s. Even Biden's people have been very vocal in their tariff talk, in their trade talk. So I think no matter what comes out of November, I think we're probably looking at more tensions between the U.S. and China. And look, Five Below, everything they sell there is that cheap plastic Chinese crap. And so tariffs is not very good for Five Below. And look, inflation just means nothing sells for $5 anymore too. So they're having a hard time. Dollar stores having the same problem. Five Below just getting absolutely crushed yesterday. Beyond disgusting, I mean, Beyond Meat also having a bad day yesterday. They're in negotiations with some of their bondholders, $1.1 billion worth of convertible notes. It turns out Beyond Meat, nobody wants to buy that garbage. Shocking turn of events. I know. Fake meat. People aren't so crazy about that. First, McDonald's cut it from their menu. And look, guys, this was obvious. Remember the meat shortage in 2021? Remember when there was no chicken anywhere? There was very little beef. There was almost no pork. Food shortages was all the rage. Remember all that? You know what there was plenty of at the store? Beyond Meat. Those shelves were fully stocked every time. So even when there is no meat available whatsoever, people still won't eat that crap. I'm just shocked to find out that they need to restructure their debt. That company probably not going to be around much longer. We got Blackstone reported some totally made up earnings because there's no price discovery in the private equity space, not for commercial real estate, not for their company assets. So, yeah, they're reporting earnings when basically everything that they own is illiquid and they're just making it up on the fly. I guess it's easy to come up with good earnings when you do it that way. And also of note this morning, we got another uptick in continuing jobless claims. That's something to keep an eye on. Initial jobless claims, also, we had an uptick, but it's back to within the band it's been in for the last few weeks. But we're seeing now week in and week out a consistent rise in continuing jobless claims. Maybe the layoffs aren't necessarily surging. They're continuing at the same pace, but people who get laid off are having a harder time finding a new job. And so we're starting to get this accumulated buildup of people out of work. That is not good for those unemployment statistics. And with unemployment goes the housing market, goes consumer spending, goes everything. So we're starting to see that jobs problem start to creep up. That's another reason why Fed rate cuts are almost a certainty in September now, because I think unemployment is now the much more important statistic versus inflation. And of course, that's not to minimize the harm that inflation is causing to people, but unemployment is becoming a bigger and bigger problem as time goes on. Why don't we shrink my big melon of a head and let's see what's going on in markets this morning. And, well, the S&P 500 looking like it's getting a little bit of a bounce here, propelled probably by the Taiwan Semiconductor. I don't think Taiwan Semi is an S&P company, but the other chip stocks that are rallying off of Taiwan Semi's news probably contributing to this bounce. And I would add that this is just a fraction of what we lost yesterday, up 20 points, 0.37% to the upside. The Dow, meanwhile, giving back some of its gains from yesterday, down 99 points or 0.25%. But the Dow had a really good last couple of days. It's up over 1,000 points in the last 4 or 5 days, giving some of that back this morning. NASDAQ also catching a bounce here, up 164 points or 0.83% to the upside. But that is after losing 511 points yesterday. So something of a dead cat in the NASDAQ here. Meanwhile, the Dixie a little bit higher this morning, 10 basis points to the upside at 103.85 for the DXY. Slightly stronger dollar here. And the bond market, we got a mixed bag this morning. Mostly higher yields at the long end. The 30 years at 4.400. That's up 4 points and change. The 10 years at 4.181. That's up almost 4 points. The 2 is at 4.45, up 2 points. And the 1 month is sitting pretty at 5.348. I'd add that's down a little bit from yesterday at where we were at 5.36. Looking over at the commodities board, we got metals are looking okay this morning. Not a lot happening. Spot gold, 24.62. That's up $3 or 0.15%. So gold still doing all right. We hit highs of as high as like 24.80 yesterday, down from those highs, but gold still holding up here near an all-time high, not quite at it. Meanwhile, spot silver got crushed yesterday on what? I don't know. All the technical indicators, all the correlations broke down in spot silver yesterday. But this morning it's up 16 cents at $30.33 for spot silver, up about 0.08%. Copper, meanwhile, down 2% for September copper futures. October platinum futures are down about 0.2%. September palladium futures down 1.33%. And West Texas Intermediate crude oil futures for September at 81.21. That's down about 23 cents here. Not a lot of movement in commodities. Just looking at silver here, guys. Again, that big red candle. We had a weaker dollar yesterday, and we had lower interest rates yesterday. So we should have seen silver doing well, but it didn't. It sold off almost $1 yesterday. So it's a little surprising to see. But of note, I would add that 50-day moving average has held, and we're now moving back to the upside. So things still looking okay for the shiny. Bitcoin, meanwhile, up $1,000 this morning on Coinbase at $65,106. Also of note is the 50-day moving average here. Pretty predictable, or not predictable, pretty textbook pattern here. We came up, recovered the 50-day, came back down, tested it, and moving again to the upside. So Bitcoin is also looking pretty good this morning. Now let's get into the main story here. Taiwan Semiconductor second quarter profit beats expectations as AI chip boom continues. And that is a fact, guys. The AI chip boom is absolutely still full steam ahead. Companies are still plowing tens, hundreds of billions of dollars into these chips. But the reason why it's a bubble is because the people who use the chips still aren't making any money, still don't have any products, and we just have to trust them that they're going to be awesome if and when they ever actually get around to putting out a product or a service. But meanwhile, big tech just keeps pouring the money in here. Surging demand for advanced chips used in AI applications has boosted Taiwan's shares by nearly 70% so far this year. The demand for generative AI is surging in the cloud and at the edge. I don't know so much about the edge. Taiwan Semiconductor's 3-nanometer process boasts good yield rates and well-managed production lines, said Brady Wang, an associate director of Counterpoint Research, on Friday ahead of the results. Taiwan Semiconductor on Thursday beat revenue and profit expectations in the second quarter as demand for advanced chips used in AI applications continued to surge. TSMC reported net revenue rose 40.1% from a year ago to 673.51 billion. I believe that is, I don't know what the currency is in Taiwan, but we'll say Taiwan dollars. While net income increased 36.3%. So high double-digit gains in both income and revenue. That's fantastic any way you look at it. The firm guided second quarter revenue between $19.6 and $20.4 billion. So pretty healthy beat there. Now we had some more. Where else was it? Hold on. All right. For the third quarter, the business is expecting to be supported by strong smartphone and AI-related demand. Of note that they're saying strong smartphone there. Smartphone sales have been pretty lousy for the chip makers for the better part of the last year. I guess they're putting a lot of stock in that new iPhone, the iPhone with Apple Intelligence. Maybe it's going to be awesome, maybe not. Adding that they continue to expect 2024 to be a strong growth year for Taiwan Semiconductor. TSMC projects third quarter revenue between $22.4 billion and $23.2 billion. That compares to $17.3 billion in revenue posted in the same period a year ago. So that's something like 29 to 35% growth that they're forecasting for revenue for the next year. So for the next quarter. So hey, they're saying the growth has been fantastic. It's probably going to continue. We're still hearing stories about Tesla or Grok AI, whatever Elon's new AI is. They're buying tens of thousands of chips. The big tech companies, Microsoft, Facebook, Google, they're still plowing money into chips. I'm sure CoreWeave is going to get another line of credit for another $20 billion worth of chips at some point. So the spend on the hardware is continuing, and Taiwan Semi stock right now is doing pretty good, up 3.2% this morning at $176.79. But I would add that's only about half of what it lost yesterday on that big bloodbath in chips. So I guess we'll call that a Pyrrhic victory for Taiwan Semiconductor. Now we got earnings from Blackstone. Blackstone profit misses estimates as real estate exits slow. I don't even know why I'm covering this one, to be honest with you guys, because nobody really knows what Blackstone's assets are worth. They're not selling any of their companies. They're actually borrowing against their companies to make it look like they have profits to distribute to their partners. They gated exits from their commercial real estate REIT for over a year. I mean, for the last 2 months, they haven't restricted withdrawals from that fund, but Starwood has. We just don't know what the stuff Blackstone owns is really worth. So I don't know how they can actually report reliable earnings, but here it is. Blackstone's real estate arm weighed on its investment giant's second quarter results as high interest rates crimped property valuations and investors pumped less money into the business. The world's largest owner of commercial real estate slowed the pace of real estate exits while it grappled with the market's shifting fortunes. Profit gains in credit and private equity weren't enough to offset the drag on fee-related earnings, which fell 3% to $1.11 billion. Distributable earnings or profit available to shareholders increased 3% from a year earlier. Now, guys, I have to ask you here. Do you, like, just this far here, is this even believable here? The world's largest owner of commercial real estate, and think about some of the bloodbath headlines that we've seen in commercial real estate over the last year, and yet they're saying distributable earnings increased 3% from a year ago. This is on its face absurd. I don't know how they come up with their earnings over at Blackstone, how they value their stuff, but this sure as heck is not what they could sell their ship for. Anyways, the firm confronted a spike in redemptions in the last 2 weeks of May after real estate investment trust of rival Starwood Capital dramatically limited investors' ability to cash out. Blackstone's $57 billion REIT held off on restricting outflows for 2 consecutive months, even though withdrawal requests hit levels that would have allowed it. In June, BREIT investors requested 50% less redemptions than they did in May. So I guess the request for withdrawals slowed a little bit, but they're just, guys, they can just make things up here. I guess that's what it comes down to. Blackstone stock down about 0.2%, trading at $133.94. That's after being down 1.5% yesterday as well. We also got earnings from Domino's Pizza. Continues to grow sales as peers struggle, but the stock slumps. Now, I was kind of struggling with the Domino's story a little bit here today. Let's just go through this one because some of the numbers look pretty good. I got to wonder about this overseas thing. Domino's Pizza grew revenue by 7.1% in the second quarter, even as other restaurant chains struggled. Okay, 7.1% restaurant growth. I mean, revenue, that's amazing. The pizza chain also posted earnings early Thursday that beat Wall Street forecasts because of one-time gains. For the 3 months ended June, the company grew earnings by 30.8%. That's incredible. From a year ago to $4.03 a share. Analysts polled by FactSet had expected $3.68, so it's a big beat. Revenue came in at $1.1 billion, slightly below expectations, so that's not so good. But the earnings gain was primarily due to a change in pre-tax unrealized gains and losses associated with the company's investment in DPC Dash, its exclusive franchisee in the China region, according to Domino's. So it looks like most of that earnings beat was just a one-off being driven by this Domino's franchise. Now, here's another good data point. Same-store restaurant sales increased 4.8% at U.S. stores. All right, that's well ahead of the rate of inflation. So more pizza is leaving the restaurant. But check out that international number. Same restaurant sales increased 2.1% at international locations. That, not so good. That's well below the rate of inflation in most of those countries. So it looks like consumers overseas not eating as much pizza as they did a year ago. The company also continues to expand its footprint. Last year, management announced a 5-year growth plan dubbed Hungry for More. That includes 1,100 new store openings through 2028 and an annual boost to sales by 7%. Still, there are headwinds ahead. The company had planned to open over 925 net new stores in international markets this year, but management now expects that number to fall short by 175 to 275 due to challenges faced by one of its major franchisees. And I think that's probably why this stock is getting clobbered this morning, is that big reduction in their plans for new stores. There's something going on in international markets for Domino's that's really hurting them. Check out the stock this morning getting clobbered on what was otherwise a pretty good earnings report. Stock is down 14.34% here, trading at $405.41. That's down almost $68 this morning. So Domino's Pizza just getting absolutely crushed here. But guys, I would add, take a look at the year to date. All right, we started the year around $400. We're trading at $473 right now. So this stock has had a pretty monster run. I mean, if you look at a one-year chart, this stock has done fantastic over the last year, giving back a lot of those gains this morning, though, presumably on some of that tension overseas. Now, in a story that had me giggling a little bit yesterday, Beyond Meat engages with bondholders to discuss balance sheet restructuring, according to the Wall Street Journal, which just had me saying, You think? You think? I don't know anybody that eats this garbage. I really don't. And I always see it at the supermarket. There's always plenty of it on the shelves. So what do they do? Is there just a guy who puts this stuff out, and then a month later when it's still sitting there, he throws it in the garbage and replaces it with new stuff, and then they lean on the bond market to make the company appear solvent? Is that what's been going on? I don't know, but nobody's eating this stuff. I can tell you that. Beyond Meat has engaged with a group of bondholders to initiate discussions about a balance sheet restructuring, i.e., we're not going to pay you back, so how big a haircut are you going to take? That's according to the Wall Street Journal on Wednesday, sending its shares down 13% in extended trading. The group of bondholders, which has interest in Beyond Meat's $1.1 billion of convertible notes, is working with the law firm Aiken, Gumpf, Strauss, Hauer, and Feld, that's a lot of partners, on restructuring. The Wall Street Journal reported, citing people familiar with the matter. The faux meat maker's reduced liquidity is attributed to its cash burn over the past several years. Beyond Meat and the law firm did not immediately respond to Reuters' request for comment. Demand for Beyond Meat's products, including burger patties, sausages, and ground beef, has weakened as customers such as McDonald's and Yum brands saw sluggish consumer demand owing to sticky inflation. Yeah, it's possible it's owing to sticky inflation. That's entirely possible. That's why people didn't order Beyond Meat. It's also entirely possible that that's because it's disgusting and nobody wants to buy your commie soy patties. Maybe that's why nobody's selling this stuff. Beyond Meat stock down 12.5% today. That's after falling 4.25% yesterday, trading at $6.27. Look at the fall from grace. Look at a 5-year chart of Beyond Meat. In 2019, this was a $167 stock, now trading at $7. Look, guys, even when there was no meat on the shelf, there was no chicken, barely any beef or pork, people still wouldn't buy this crap. The writing was on the wall during the meat shortages of 2021. And yet here we are, just shocked, saying maybe it was inflation is the reason why people won't buy this stuff. No, nobody wants to eat it. That's the problem. Meanwhile, Five Below slumps to 2020 low as retailer loses analyst faith. Barclays, Citi, and Morgan Stanley among brokers to cut the ratings as product stumbles and risks from tariffs weigh on the outlook. Wall Street enthusiasm for Five Below plummeted along with its shares on Wednesday with the departure of its longtime chief executive officer and worries about tariffs driving analysts to the sidelines. The discount retailer on Tuesday announced CEO Joel Anderson's departure and cut earnings per share guidance for the second quarter, leading brokers including Barclays and Citigroup to drop their buy recommendations on the stock for hold equivalent ratings. The consensus rating, a proxy for the ratio of buy, hold, and sell ratings, fell to 3.8 out of 5 on Wednesday, its lowest since September of 2018. The share slumped the most since March of 2020. Though Five Below had already reported some product missteps, it's also vulnerable to changes in resilience of lower-income American consumers. That's come into focus in recent months, with retailers noting shoppers shifting their spending towards essentials. The consumer outlook is also clouded by the U.S. political environment, with presidential candidate Donald Trump pledging to institute new tariffs on imported goods should he return to the White House. And guys, I would add, Trump's probably going to do more tariffs than Biden would, but Biden has been sticking with the tariffs and threatening more as well. So either way, Five Below is going to find themselves paying up extra for all of that imported Chinese crap. They bought too many Squishmallows. They got all that stranded inventory. Their consumers have nothing left after they pay for food and rent. This is just a company that is getting clobbered on all fronts here. Five Below stock dropped 25% yesterday. It's down another 0.5% this morning, trading at $76.11. And we've also got earnings from D.R. Horton here. D.R. Horton stock drops as the number and value of new home orders fell short. Pay attention, all you housing bulls out there. The home builders starting to show some weakness here. Shares of D.R. Horton slumped in early trading Thursday after the home builder reported fiscal third quarter earnings that rose above analyst expectations, but the number and value of new home orders were well below forecast. The company also trimmed its full-year outlook for revenue, but nudged up its guidance for home closings and approved a new $4 billion stock repurchase program. Gotta love those stock buybacks during tough times. Although inflation and mortgage interest rates remain elevated, the supply of both new and existing homes at affordable prices is still limited, and demographics supporting housing demand continue to be favorable, CEO said. Homes closed increased 5.1% to 24,155, while the value of homes closed was up 6.1% to $9.23 billion, to imply an average price of $382,165 per homes closed. So that is pretty good. I mean, the estimate was for 22,256 homes. So they sold more homes than expected. And the average closing price was higher than the market was expecting. New sales orders edged up just 0.5%, though, to 23,001. And the value of sales orders was flat at $8.7 billion. Those were well below the FactSet consensus for new orders of 24,738 and new order value of $9.56 billion. So it's those new orders, the pipeline for new homes, not looking so good. Check out the rental operations. Rental operations revenue dropped 38% to $413.7 million, but beat expectations for $368.1 million. A 38% drop in rental revenue. There's got to be something going on behind the scenes. Either they just sold a major block of their build-to-rent homes, or a lot of people just aren't paying their rent. But 38% drop, that seems like kind of a big number. Like there's more going on to the story of that rental revenue at D.R. Horton. Maybe we'll look into that later. For fiscal 2024, the company revised its guidance range for revenue of $36.8 billion to $37.2 billion. That's from the $36.7 to $37.7 billion, with the midpoint of the range falling to $37 billion from $37.2. So they lowered their guidance a little bit. The market is not going to like that lowered guidance. Right now, Yahoo Finance is not showing any change. Oh, well, that's because this is the wrong ticker. Why don't we put up D.R. Horton and see what we actually get? D.R. Horton, where are you? Here you go. DHI is D.R. Horton. Okay, their stock's actually up 6% pre-market. Wow. All right, so the market is liking this news. Not sure what the good news was in that D.R. Horton earnings report. Maybe they said something in their conference call that the market liked, but stock was down earlier today. All right, shifting gears a little bit here. Let's take a look at initial jobless claims in the United States. Nothing too big here. The number of people claiming unemployment benefits in the U.S. fell by 17,000 from the prior. This is last week. Let me refresh that. There we go. The number of people claiming unemployment benefits in the U.S. rose by 10,000 to 243,000 for the period ending July 13th, reaching a new weekly high, surpassing market expectations for 230,000. The increase, along with other key indicators, suggests that the U.S. labor market continued to soften this period, bolstering expectations that the Federal Reserve may lower benchmark borrowing costs by September. So here's the weekly initial jobless claims. Look, we kind of made a new trend here these last couple of weeks. You know, we were down for most of the fall and the winter. We were down here around 215,000. Now we're up here around 235, 240 for a couple of weeks in a row. But it's not so much the initial jobless claims that you need to worry about. These are slightly elevated, but take a look at continuing claims. Continuing claims in the United States increased. Let me refresh and make sure I have the most current. Here we go. Outstanding jobless claims or continuing claims in the United States rose by 20,000 from the previous week to 1.867 million in the first week of July, above market expectations for 1.86 million. It was the highest amount of outstanding claims since November of 2021, underscoring the increasing difficulty for the unemployed to find suitable employment. And this is the chart that I think is more worrying, more so than those initial claims, right? We're not seeing mass layoffs yet. There's a lot of stories out there about layoffs, but what we are starting to see is accumulated unemployment, right? This number is getting a little bit higher pretty much every week. All right. So even though we're not seeing a surge of people losing jobs, the people that are losing them can't find new jobs, and so the total is starting to pile up here. Pay attention, guys. That unemployment rate, and especially because we're talking about the September rate cuts here, which is virtually guaranteed at this point. Typically, a big spike in unemployment follows within just a few months of that first rate cut, because the Fed is always too late to act. They're always reacting. They're never out in front of the trend. So, you know, right now we're looking already early signs of a spike in unemployment. This isn't that alarming, right? Let's zoom out a little bit to put it in perspective. Here's a 5-year chart. All right. So when you scroll out to 5 years, obviously we're nowhere near where we were back during the peak in COVID. That just totally messes the whole thing up. Of course, if you look at where we were in the GFC, nowhere near where we were in the GFC. So, you know, temper the enthusiasm a little bit. Historically speaking, these continuing claims aren't that high, but we are seeing a pretty consistent uptick. And I just want to end on a slightly positive note. Ford adding 2,000 workers at 3 plants to build more trucks. We don't all do doom and gloom here. We do plenty of doom and gloom, but we also cover the good news. Ford on Thursday said it will add 2,000 jobs to increase production of its Super Duty F-Series pickup trucks at 3 plants with an investment of about $3 billion. The move will add production of up to 100,000 units of its Super Duty trucks to the Oakville plant. Ford said it will secure about 1,800 jobs at Oakville Assembly Complex in Oakville, Ontario, and add about 150 jobs at Windsor Engine Complex in Ontario, plus about 70 jobs and additional overtime at U.S. component plants. So, okay, 2,000 more jobs. They're all in Canada. It's not going to affect U.S. unemployment, but hey, they're building more big Super Duty trucks. It's nice to hear about something other than freaking EVs for a change. That's all I can say. Seemed like a pretty good, that's a feel-good story to end the show on. I kind of like that one. Thank you very much to Nashville Pasta Man. I'm a vegetarian. All my food eats veggies. I see what you did there. All of your food eats veggies. All right. So yeah, I guess, we're all vegetarians once, twice, thrice removed along the food chain, right? It's kind of like the Kevin Bacon thing. If you go back, what your food eats and what its food eats, eventually we're all vegetarians, I guess. I don't know. Maybe. Thanks, Nashville Pasta Man. Look, I'm a carnivore. I'm an omnivore. I'm on the carnivore diet right now, which means I'm hungry and angry most of the time. But I dropped 7 pounds so far. I've only been doing it for 2 weeks, so it's not that much. 7 pounds is a rounding error for me. But thank you very much, Nashville. Appreciate the super chat, support of the channel, sir. And Cole Marsh, get your silver and go fishing. I got my silver here. What's with the go fishing, by the way, Cole? Is that like implying a boating accident? Should Uncle Sam ever decide they don't want the plebs to own silver anymore, and that's when everybody goes fishing and has a boating accident? And man, I shouldn't have brought my silver stack fishing with me. Is that what you're implying there? Either way, I like the shiny and I like fishing and I like super chat. So thank you very much, Cole. Appreciate the support of the channel, brother. And thank you to Steve Woitis, who says, if you're interested in AI, Nobody Special Finance's interviews with Carl from Internet of Bugs is a must watch. Wow, thank you, Steve, for the super chat promoting my videos. Let me just say, I had such a pleasure talking with Carl from Internet of Bugs over the last week or so. We sat down for an interview. I didn't mean for it to run so long. It was over an hour long combined, so I broke it up into 3 parts. It was more manageable that way. But honestly, I could have talked to Carl for 2 hours. And to be honest, Carl and I spoke on the phone for about 2.5 hours before we did the interview also. He is a really sharp guy. He knows a lot. He's been around. He's seen a lot of things, done a lot of things. And it was really a pleasure to hear somebody with a technical background, with a software background, confirm some of my suspicions about these ridiculous promises that the rockstar CEOs have been making in AI. And I second that. I really recommend that interview. It was in 3 parts, guys. The first one was about how AI companies fake their demos and get away with it because the press is just cheerleaders for them. The second was about our psychological predisposition and gullibility that we're almost naturally hardwired to believe our machines are smarter than they really are. And there's a long history of that. And the rockstar CEOs are taking advantage of that with the kind of products that they're putting out. And the last chapter, was about the big data problem that AI has and what happens when artificial intelligence, when these large language models start training on their own outputs. In other words, when AI starts eating itself, it's going to get dumber. And I think we're probably going to start seeing that very soon because they're almost out of data. And the people that have the data starting to say, you can't have it for free. You got to pay us. Either way, AI has a big data problem. Thank you, Steve. Appreciate the super chat, sir. Again, check out those interview videos. And thank you to T.A. Chapman for gifting 10 Nobody Special Finance memberships. Thank you so much. Guys, if you received one of those memberships, send TA a thank you very much. Appreciate the support of the channel, sir. And thank you to my channel members for supporting the channel as well. Joey Sock says, hit that like for the algo. Absolutely. And I could use the algo good graces, by the way. I don't know if you guys noticed, but I got a lot of comments yesterday. My live stream just didn't show up in anybody's feed. I don't know if you guys are having that problem today, but yesterday it just didn't show up on my channel feed. People didn't get notifications. I don't know what happened. Hopefully that didn't happen today. It wasn't me. We still did the stream, but thank you to all the people who couldn't find it but kept looking. I appreciate the enthusiasm, guys, and thank you, Joey Sox. Appreciate the super chat, sir. And True Rebel, thank you very much, True Reb, for the super chat. Nothing to say, just being a swell guy. I'm looking for True Reb. Thank you so much. Appreciate that. Okay, he says, watching from Canada. All right, True Rebels watching from Canada. the proud recipient of those 2,000 jobs at the Ford plant in Ontario. Thank you very much from north of the border for supporting the channel. And thank you, everybody, for having your coffee with the Melonheads this morning. I appreciate that very much. Thanks again for all the super chats, guys, and to my channel members and magnanimous Melonheads on Patreon for supporting the channel. You guys are awesome. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.